Merry Christmas. Everyone, it's your favourite guy from the East. I can guess what many of you are doing right now. Probably lounging on the sofa, recovering from a big holiday meal. Maybe the kids are enjoying their new gifts, or you're sharing a drink with relatives. You're glancing at your phone, checking the silver price, and you see it. Calm, flat. It's hovering around $71.94 to $72.10. Not a single movement in the past 24 hours. The chart looks frozen. The usual noise is gone. For the first time in a year, the chaotic swings of the silver market have gone completely quiet. It feels comforting, doesn't it? Like the battle is over for the year. Like it's safe to finally exhale, close the laptop, and wait for January to come. But I'm recording this message on Christmas night for a reason. I need to share something your financial advisor won't mention. I need to reveal something the mainstream finance channels, currently looping their year-end highlight reels, are completely overlooking. This stillness, this calm, is deceptive. We're standing right in the eye of the storm. And tomorrow morning, December 26th, the other side of the hurricane hits. We're entering a rare and risky moment that experienced traders only discuss in hushed tones. It's known as Ghost Week. If you've been in the markets for under 5 years, you might not even be aware of it. You might assume markets are either open or closed. That Tuesday trades the same as Friday. But in the fast-paced, leveraged battlefield of the futures market, especially on COMEX, time behaves differently. Ghost Week refers to the trading days between Christmas and New Year's, specifically, from December 26th to January 2nd. During this brief window, the entire architecture of global finance temporarily shifts. Now think about who usually drives the market on any ordinary Tuesday. It's the seasoned risk officers at the biggest institutions. It's the lead traders at giant hedge funds. It's the elite algo desks based in London or Hong Kong. These are professionals with years of experience and, more importantly, with access to billions of dollars they can deploy to keep prices stable. But this week, those heavyweights are gone. They've headed off to Aspen for skiing. They're relaxing on yachts in the Caribbean. They've unplugged, shut down their terminals, and closed out their books for year-end. They've handed over control to the skeleton crew. And who makes up this crew? Junior staff, interns, and background algorithms running on minimal settings. Their mission is simple: don't mess anything up. This drop in participation means one thing. Market volume, the lifeblood of daily trading, plunges by anywhere from 70 to 90%. And this sets the stage for one of the most hazardous dynamics in finance, the liquidity vacuum. It's critical that I break this down for you, especially if you're trading with leverage right now. Understanding how a liquidity vacuum works could be the difference between making a fortune next week or watching your account get wiped out. Picture the silver market as a frozen lake. On a typical day, the ice is 10 feet thick. You could drive a semi-truck over it. If a major sell order hits, maybe someone offloads 5,000 contracts. That thick ice absorbs the shock. The price might slip 10 cents, but the limit orders catch it. These orders form the structural walls of the market. Thousands of buyers sit stacked at $71.90, $71.80, $71.70. They're there to absorb impact, to stabilize. But during Ghost Week, that solid surface melts away. The ice turns thin, paper thin. Why? Because the experienced traders who place those limit orders are gone. And when they leave, the structure starts to fail. They've pulled their bids from the book. The support walls vanish. So now we're looking at a market with no depth. The surface still looks calm, but underneath it's hollow. What happens when a big order enters this hollow environment? Say a sovereign fund decides to rebalance, or a hedge fund panics and rushes to close a short position. In a thin book, that order doesn't get absorbed. That order won't find a buyer at $71.90. It won't even find one at $71.80. It can slice through the book where bids used to be. It might need to fall all the way to $68 to find someone willing to take the other side. That kind of drop is called slippage, or an air pocket. It's a move created by missing liquidity, not by a normal tug of war. And this phenomenon doesn't just work to the downside, it works both directions. Imagine a sudden surge in buying, perhaps sparked by a breaking headline out of Venezuela. We'll cover that in part 2. The price won't gently tick upward to $72.10. In Ghost Week, it doesn't climb step by step, it leaps into empty space. It'll gap jump from 72 to 75 in one 1-minute candle. Why? Because no one's there to sell. The sellers? They're still sipping cocktails in the tropics. So the market can't find smooth price discovery. So Ghost Week isn't a moment of calm. It's an extremely unstable moment. A market so fragile that a single spark, one tweet, one breaking headline, could send prices erupting, and it can happen faster than you expect. You might be tempted to dismiss this. You might think, come on, Nothing major ever happens over the holidays. Is that so? Let's rewind. History has a nasty habit of showing up at the quietest times. Christmas 2010. Silver was quietly hovering near $29. Traders clocked out. Then, by early January 2011, silver had exploded higher, kicking off the surge that took it to $50 by April. That breakout was born in Ghost Week. Christmas 2020, the early whispers of a silver squeeze began to form in low-volume markets, and by late January, silver was gapping up at Sunday opens. It started a rally that caught the world's attention. Flashback to the 2019 yen flash crash. Do you remember what happened on January 3rd? Right in the middle of the Asian holiday period? The Japanese yen spiked 4% in just minutes. Why? Because the markets were illiquid. History teaches us that Ghost Week is when the improbable becomes real. When the rare events, the fat tails of the probability curve, decide to show up. And make no mistake, 2025 is a whole different beast compared to 2010. Back then, the world was relatively calm. Today, we're dealing with a proxy war in South America, a full-scale blockade around Venezuela, and a central bank that has surrendered the fight against inflation. On top of that, we have a silver market that's already surged 140% year to date. This market is loaded with potential energy. We are quite literally sitting on a compressed spring. Let's take a look at where things stand right now. On Christmas night, 2025, silver has just wrapped up the week at a new all-time high of $711 on the spot market. We've decisively broken through the psychological barrier of $70, and that mental shift is huge. For decades, $50 acted as the ceiling. Once that cracked, 70 became the next psychological wall. Now that line has been crossed. We're in what traders call blue sky territory, a zone with no resistance above. No old bag holders waiting to sell. Everyone left in this trade is sitting on profits. But here's where it gets risky. The Relative Strength Index, RSI, is flashing extreme, overbought levels. The Daily Sentiment Index is at a whopping 95% bullish in any normal environment. This would be the textbook time for a pullback, a round of profit-taking. Under usual conditions, traders would start selling to lock in year-end performance and bonuses, but not this time. No one is selling. Why? Because of the Asahi Vault drain that happened on December 23rd. The smart players in the game know there's practically no physical silver left. They know if they sell their contracts at $72, they might not be able to get back in. That far changes everything. They could blink and wake up on January 2nd to find silver trading at $85. So they're frozen, holding and waiting. What we have here is an extremely bullish setup trapped inside a market with barely any liquidity. It's a recipe for something explosive. So what should we expect tomorrow? December 26th, markets open for a short post-holiday session. Trading volume will be near zero. But the arbitrage bots that link New York to Shanghai, they'll be fully operational. Now here's the kicker. Shanghai is currently pricing silver at $77, while New York is still sitting at $72. That $5 discrepancy is like a stretched bungee cord, constantly pulling New York prices upward. And tomorrow, even in thin trading, that pull is still in effect. If even a single industrial buyer, say, a battery plant that stayed online through the holidays, decides to hedge their January needs tomorrow, it could be enough to send the price skyrocketing. In a thin market, it doesn't take much. One committed buyer can move everything. If we see a gap up in price tomorrow, it could define the entire mood of the market heading into January. It would trigger a wave of FOMO among institutions that are currently sitting on the sidelines. Holding cash. That's how a quiet session turns into a stampede. But there's one key piece we haven't talked about yet, the spark. A liquidity vacuum is dangerous on its own, but it still needs something to ignite it. It needs a catalyst to light the fuse. While you were enjoying your Christmas dinner, something major happened in the Caribbean. While you were unwrapping gifts, the US Navy took action, a move that hasn't yet made headlines in the mainstream media. Reports are coming in of a significant escalation in the Venezuelan blockade. And this time, the vessel involved doesn't belong to Venezuela. It's linked to a nuclear-armed state. 3 days ago, the US Coast Guard intercepted a ship named Bella 1. Just yesterday, they boarded another vessel, the Centuries, owned by a company based in Hong Kong. Think about that for a moment. Hong Kong means China. The US military forcibly boarded a China-linked ship in international waters as part of enforcing an oil blockade. This has moved beyond sanctions. This is now a direct challenge between global powers in the Western Hemisphere. Moscow has already voiced its support for Maduro. Beijing has remained silent, but that silence is loud. China and Russia are the main customers for Venezuelan oil. Their supply chain is being deliberately choked. So, why does a tanker in the Caribbean have any connection to silver prices tomorrow morning? Because silver is what we call a war hedge. When military forces block trade routes, global macro algorithms kick in with a very clear set of rules. Dump risk assets. Buy safe havens. Normally, this flow would head toward the US dollar, but check the dollar index, the DXY. Is sitting at 97.94, a 12-week low, has dropped nearly 10% this year. Confidence in the dollar as a safe haven is fading, especially since it's now being used as a weapon in this economic conflict. So where does the capital flow instead? It flows to gold, and it flows to silver. If we wake up on December 28 and see a headline announcing a Russian warship heading toward Venezuela, panic buying will hit the markets, or if we see a formal warning issued by China, the same thing happens, and as we discussed earlier, there is no liquidity. If $1 billion of fear-driven capital tries to flood into the silver market during a thin holiday week, it's not going to move the price gently, it's going to blow the roof off. In this environment, the move won't be a grind, it will be a jump. But the geopolitical story is only half the equation. The second and far more devastating factor is the central bank's capitulation. Just before the holidays, something crucial happened. Federal Reserve Governor Christopher Waller gave a speech that, in essence, raised the white flag. Inflation is currently sitting stubbornly at 2.7%. The target, however, is 2% flat in a rational market. The central bank would be raising interest rates to bring that inflation down. But instead, Governor Waller has signaled that the market should prepare for 2 additional rate cuts in 2026. Let that sink in. Inflation is above goal. Unemployment is creeping up, now at 4.6%. And yet, the Fed is loosening policy. What they're really saying is this. They've run out of options. They're quietly acknowledging that the $36 trillion national debt is too heavy a burden to keep the system afloat. They have no choice but to lower rates, even if it means letting inflation simmer well above target. And for silver, this is the most bullish environment imaginable. Silver thrives in a world of negative real interest rates. When rates fall and inflation stays hot, the math turns against cash. That's when real assets start to look unstoppable. Let's look at the numbers. Interest rates are sitting at 3.75%. Meanwhile, real inflation, if you follow shadow stats, is likely somewhere between 8 and 10%. Even the official rate is 2.7%. No matter which metric you use, if you're holding cash, you're losing ground. Your purchasing power is leaking every day. The gap between inflation and rates is the silent tax, and it's exactly the kind of environment silver feeds on. And now the Fed has made it clear they're going to increase the money supply again in 2026. That signals more liquidity, more dilution, and more pressure on the currency. Markets don't wait for the calendar to flip. They reprice early. This is why the dollar index has been falling hard over the holiday period. The so-called smart money is getting out of dollars before the new calendar year begins. They're positioning ahead of policy easing. They're front-running the next wave. Now let's connect the dots for what's coming next week. On one side, we have the spark, an escalating geopolitical standoff in Venezuela. It pulls China and Russia into the spotlight, and it triggers safe haven flows. On the other side, we have the fuel, a central bank that has surrendered its inflation fight. That decision hammers the dollar, and it pushes investors toward real assets. It also changes expectations fast. And sitting between them is the vacuum, Ghost Week. It's a market stripped of liquidity, with no sellers and no depth. When the book is thin, normal moves don't stay normal, they gap. If these 3 forces converge Tuesday morning, we're not looking at a simple $1 pop. We're looking at a potential $8 surge. Silver could open at $80, and it might never look back. Now, to be fair, let's consider the other side. Is there downside risk? Yes, absolutely. If tensions in Venezuela cool down, or if the bank interns still manning the desks decide to take profits for year-end bonuses, we could see a temporary flush. That flush could run down to $68. In a thin market, downside air pockets can appear just as easily as upside gaps. Liquidity cuts both ways, and holiday trading exaggerates everything. But pause and ask yourself, who's really going to sell? Would China start dumping while their own shipping routes are under threat? Not a chance. They're buying silver as part of their de-dollarization strategy. Would the Fed be a seller? No, they're easing policy. The path of least resistance is clearly to the upside. And even if we get a dip, it won't last long. Meanwhile, amid the political chaos, something alarming has occurred in New York's vaults. On December 23rd, just 2 days ago, one of the biggest vaults in the COMEX network was cleared out. over 1.4 million ounces of silver disappeared overnight. Here's the thing, you can print more dollars, you can announce more rate cuts, but you can't fabricate 1.4 million ounces of physical silver. That's the hard limit that money printers can't cross. Take a look at the official silver stock report from CME. Normally, inventory shifts are uneventful. 10,000 ounces in, 10,000 out, it's background noise, but this time. One line stands out, Asahi Refining, negative 142,453 ounces. That's not a typo. In just one day, over 1.4 million ounces were withdrawn from Asahi's registered category. It's a withdrawal on a scale that doesn't happen by accident. Now, what does registered mean? It refers to metal that's available to be delivered against a futures contract. In other words, it's the for sale supply. When registered drops, deliverable inventory gets tighter. On December 23rd, someone walked into the Asahi vault and pointed at approximately 1,400 bars, and they said, "We'll take those, remove them from the market." That's not a trade, that's a physical extraction. And they weren't the only ones. JP Morgan's vault saw nearly 600,000 ounces disappear. CNT lost over 228,000. StoneX dropped just under 25,000. In total, more than 2.2 million ounces vanished from available inventory, and it all happened within 24 hours. That kind of synchronized drain is a loud signal. It tells you someone needed metal fast. So why is this significant going into Ghost Week? Because typically, when silver hits a new all-time high, like $711, you'd expect inventories to rise. People usually take profits into strength. Vaults should be overflowing, not emptying. The logic is simple. If you bought silver at $25 and it hits $71, you'd usually sell into the rally. That selling should push bars into the system. The warehouses should look heavier instead. The opposite is happening. Price is hitting records, and yet metal is flying out of the vaults. That's the classic sign of a cornered market. It suggests the paper price is not reflecting the scramble for physical, and it means the real market is happening off-screen. Who's taking the metal? Based on the scale and urgency, it's likely a mix of sovereign wealth funds and industrial buyers, especially battery manufacturers, who can't risk supply disruption. They're not buying because it's cheap, they're buying because they need possession. They see Ghost Week approaching, and they know liquidity is drying up, so they acted fast to secure physical silver before the market thins out even more. That kind of pre-positioning matters more than headlines. It changes the floor under the market. This kind of activity creates what I call a hard floor in the market. People worry about a crash and ask, what if silver drops to $60 next week? But here's why that's mathematically unlikely. The spread is already doing the cushioning. At the moment, silver is trading around $77 in Shanghai, while New York sits at $72. That's a $5 difference. Now imagine New York drops to 65 and the spread widens to $12. Every arbitrage bot and institutional desk will instantly buy New York and sell into Shanghai for risk-free profit. And that flow acts like a cushion, a price safety net. But because inventories at Asahi and other vaults are being drained, that safety net is shrinking by the day. Even if a flash crash hits during Ghost Week, it'll be short-lived. The physical buying pressure is simply too strong for the paper market to collapse, and the fundamentals don't support a breakdown. But here's the part that poses real danger for the banks. With 1.4 million ounces leaving Asahi, the float has shrunk dramatically. The float is simply the amount of silver available to trade. And when float shrinks, small moves can turn into violent moves. Tomorrow, options dealers will need to hedge their exposure. Their short call options at $72 and $75. If the market gaps higher, they must buy futures to stay hedged. That's not a choice, it's mechanical. But the problem is obvious. Where do those contracts come from when the physical metal backing them has already left the vault? Inventory is gone, and sellers are scarce. The hedging demand shows up anyway. That imbalance is where chaos begins. This is the setup for a classic gamma squeeze. Dealers are forced into buying, but sellers are nowhere to be found, so they're compelled to bid higher, 73, 74, 75, and the higher it goes, the more they must buy. It becomes a brutal feedback loop. Every uptick increases dealer hedging needs, and it's unfolding during a week when liquidity is virtually non-existent. That's why a quiet chart can be the most dangerous chart. So don't let the calm price action lull you into complacency. The vault data tells a very different story. The smart money is nervous. They're locking in physical supply at any price. Asahi was drained on Tuesday so they wouldn't be exposed when markets reopen on Monday. That timing matters. It's pre-positioning before the thinnest part of the week, and it signals urgency, not comfort. Now let's turn to the chart. We already have the fundamental driver. geopolitical conflict. We have the supply driver, the volt drain. What we need next is technical confirmation. Look at where price sits today, around $72. Are there any resistance lines above us? Any old highs? Any long-term bag holders waiting to sell? No, we're in what technicians call price discovery. I prefer to call it blue sky. And once you enter blue sky territory, the normal rules of gravity no longer apply. Here's how markets usually behave. Price rises until it hits resistance, and resistance is simply people who bought at those levels years ago and want out at break even. That's why those levels can act like ceilings. At $30, sellers showed up. At $50, selling pressure was enormous. But at $72, there are no sellers left. Everyone who has ever bought silver, at any point in history, is now in profit. No one is trapped. No one is desperate. That creates a complete absence of selling pressure. And when you combine that selling vacuum with panic buying driven by geopolitical fear, you don't get a steady uptrend, you get a vertical move. Now let's talk about the machines. Roughly 80% of trading volume on COMEX comes from high-frequency trading systems and CTA algorithms for over a decade. These systems followed one basic rule. When silver hits resistance, short it. But when Ghost Week begins tomorrow, their breakout logic takes over. If price makes new all-time highs and volatility expands, go fully long, and the machines stop fighting the move and start chasing it. And here's the thing about algorithms. They don't care what the price tag says. Is $80 considered too high? The bots don't know. Is $100 excessive? They don't care. All they're programmed to recognize is that price is breaking new highs, so they buy. And during Ghost Week, with almost no liquidity in the market, every one of those algorithmic buys pushes the price up even further. That move then triggers even more buying. This is the self-reinforcing cycle, the algorithmic feedback loop that creates explosive upside gaps. The chart doesn't climb smoothly in that environment. It jumps, and each jump feeds the next one. Now, I already know what the skeptics are thinking. But look at the RSI. It's at 85. That's overbought. It's bound to crash. That's the classic argument. Let me let you in on a secret. Overbought signals during a bull run are often traps. They look like sell signals on paper, but in strong trends, they can persist, and they can punish anyone who shorts too early. In 1980, silver entered overbought territory at around $15. Did it reverse? Not even close. It kept climbing all the way to 50. It stayed in overbought conditions for 5 straight months. In 2011, it became overbought at $28, and still, it surged to 49. The indicator didn't stop the move. The move overwhelmed the indicator. In a true parabolic breakout, which is what we're seeing now, an RSI of 85 isn't a sell signal. It's a warning that the trend is aggressive, and it's a warning that shorting into that strength is dangerous. If you base your trade on some technical tip you picked up from a beginner's video, you're likely to get steamrolled. Markets can stay irrational much longer than your account can stay alive, and right now, we're not just facing irrational behavior, the market is structurally broken. So here's what I expect to see play out on the chart next week. Due to the lack of liquidity, don't expect smooth price action, expect it to move in jagged steps. The tape will look abnormal. On Monday, we could see silver close around $72. Then on Tuesday, if Venezuela makes headlines, we might see the very first trade print at 75. That would be a $3 gap, and it would set the tone fast. Why does that happen? Because the algorithm searches for a seller at 72.50. Nobody. Then it looks at 72.10. Still no one. It keeps scanning up the ladder until it finds the first willing seller. And that seller may be sitting at 75. So, the price leaps straight there. This sudden jump leaves a price gap on the chart. And although traders often believe gaps must eventually close, in supply crisis environments, gaps can remain open for years. But let's not act like this is uncharted territory. We've traded through holiday squeezes before. I want to take you back and show you 2 key examples. Christmas of 2010 and Christmas of 2020. History may not repeat itself exactly, but it often echoes. And those previous Ghost Weeks offer a clear preview of what could unfold in January 2026. One word of caution. Though, the current setup is far more volatile than what we saw in 2010, doubters love to say. Nothing ever happens during the holidays. It's a quiet zone. Just relax. But I'm telling you, that mindset is dangerous. Some of silver's most aggressive and defining moves began in this so-called dead zone. Ghost Week isn't a break. It's a launch pad. Let me take you back to 2 very specific holiday periods. Christmas of 2010 and Christmas of 2020. These are the ghosts of Christmas past. and they are flashing a clear warning about what may unfold in 2026. Start with the chart on the left, December 2010. If you were active in the market back then, you remember the mood. Silver had been climbing all year. It was trading in the range of $29 to $30. The media was shouting, "Bubble!" The RSI was flashing overbought signals. Banks and analysts were urging everyone to lock in profits before year-end. Most traders followed that advice. They sold their positions and went on vacation. But what happened between Christmas and New Year's? The price didn't fall. Instead, it slowly crept higher. $30, $30.50, $31. Why? Because the sellers had disappeared. Ghost week. Meanwhile, the physical buyers, the smart money, kept accumulating. With the liquidity thin, they were able to walk the price higher. It didn't take much volume to move it. There was very little resistance. When traders came back from their ski holidays in January 2011, panic set in. They had sold at 29. Now silver was trading at 31. They were forced to chase the move. That quiet ghost week grind higher became the ignition point. It fed into the parabolic rally, and that rally eventually took silver to $50 in April 2011. If you sold during Christmas 2010, you missed the trade of the decade. Now shift your attention to the chart on the right, December 2020. The world was locked down. Silver was rebounding from the COVID crash during the holiday period. The narrative began to change. Talk of a silver squeeze started spreading across online forums. Once again, trading volume was thin. Once again, the banks were largely absent. The setup rhymed with 2010. And just like in 2010, price began to inch higher. It gapped up in early January. By the end of the month, silver was back near $30. The phrase silver squeeze was trending worldwide. The takeaway is simple. Bull markets thrive during holidays, when the institutions step away from their desks. Silver's natural bias is upward. Suppression requires constant effort. When that effort pauses, the pressure releases, like a beach ball popping out of the water. So why worry about 2025 if this already happened in 2010 and 2020? Because of one critical difference: inventory. In 2010, COMEX vaults were well stocked. Hundreds of millions of ounces were available. In 2020, inventories were overflowing. JP Morgan had just finished building a massive physical position. Back then, banks had ammunition. After the holidays, they could step in and push prices lower if needed. In 2025, that ammunition is gone. We've already reviewed the data. The Asahi Vault alone lost 1.4 million ounces in a single day. The swap rate is negative 7%. Backwardation. The Shanghai premium is $5. This is not 2010. This is 2010 multiplied. The rubber band today is stretched far tighter than it ever was back then. In 2010, the rally was driven by speculation. In 2025, the rally is driven by scarcity. Not excitement, starvation. If silver gaps higher next week, the big banks won't be able to slam it back down because they're out of ammo. They don't have the physical to dump, and any attempt to use paper contracts to suppress price will be instantly arbitraged away by bots in Shanghai. We're heading into a ghost week with no liquidity and almost zero inventory. This combination has never existed before. Not in 1980, not in 2011. This is uncharted territory. There's also a psychological storm building, fear of missing out. Think about the fund managers sitting at home this weekend. They see silver sitting at 72. They know their portfolios are overloaded with tech and crypto. They have almost no exposure to metals. They're reading the same headlines you are. They're watching the Federal Reserve cave in real time. If silver gaps up $3 or $4 Monday morning, it will trigger panic. These managers are required to chase returns. If silver is the only thing ripping, they're forced to buy. And in Ghost Week, those panic orders will crash into a liquidity void. It only takes a few $100 million from a desperate fund to move silver from 75 to 80 in hours. That's how thin this market is. The real risk for retail traders is getting shaken out right before liftoff. The banks know this playbook. They've used it before. They may attempt one last trap Monday at the open, dump a few contracts to trigger a quick dip to 70. It's designed to trip stop losses, force retail capitulation, and then reverse violently higher. Don't fall for it. Remember the lessons of 2010. Don't be the person who sold at 29 and watched silver soar to 50. Don't be the one who gave up at the bottom of the breakout because you got spooked by a holiday shadow. So what's the move? Do you hit the buy button at the open? Do you sit and wait? What if it gaps down first? This is where things get serious, because being right about the direction doesn't mean much if you get wiped out along the way. When liquidity vanishes, the market turns savage. It stops following technical patterns. It ignores support zones. It can drop $4 in minutes just to hunt stops, and then rocket up 8 more before you can react. Here's the golden rule. If you take nothing else from this series, take this. Stay away from high leverage next week. If you're trading futures with 10 or 20 times margin, or buying short-dated call options that expire in January, you're not investing, you're gambling, and the house always wins when the market turns irrational. In a market with no depth, we sometimes witness what are known as widowmaker wicks. This happens when a massive market order slams into an ultra-thin order book, causing the price to instantly plunge to an absurd number, like $65, for a single second, only to snap back to 72 just as fast. If you're trading with high leverage, that 1 second wick is all it takes to wipe out your position. You'll get liquidated at the exact bottom, then sit back powerless as silver rockets upward without you. Don't try to be a hero next week. If you're in paper positions, cut your size, loosen your stops, or better yet, take the leverage off the table entirely. This is not a week for fast trades or risky bets. This is a week for patience and positioning. Ghost week is sneaky. Most of the price action between December 26th and December 31st is just noise, generated by low-staffed desks and autopilot algorithms. The real signal arrives on the first full trading day of the new year, Friday, January 2nd. That's when the real players return. The hedge funds, the sovereign wealth funds, the institutional desks, they all log back in and start moving serious capital. What to look for? A bullish confirmation happens if silver opens on January 2nd and breaks above the Ghost Week high. For example, if silver reaches 74 during Ghost Week and then punches through 74.50 on January 2nd, that's your green light. That tells you the institutions are chasing the rally. That's when you press the trade. What if we gap down instead? Don't panic. Watch the $70 level closely. As long as that floor holds, the bigger uptrend remains intact. A drop to 70 at the open may just be a final trap designed to shake out weak hands before the move to 100 begins. Tune out the noise on Tuesday and Wednesday. January 2nd is the only price action that truly matters. Now let's shift to physical silver. A lot of you aren't trading futures, you're stacking. For you. Next week will be strange. You might see spot price dip, you might see the screen flash red. Maybe the media announces a silver crash to $68. Ignore it. Watch the premiums instead in a Ghost Week crunch. The futures price can completely detach from the real world, while the screen says 68. Your local dealer might be charging more, not less. For an American Silver Eagle, why? Because the physical supply is gone, and they know it. Here's the play, if we see a paper flash crash. Take it as an opportunity. Check with your coin shops. Check the online dealers. If they haven't updated their pricing yet, that's your moment to strike. You're buying real metal at a discount to manipulated paper. That arbitrage window will slam shut quickly. Don't hesitate when it opens. Now let's walk through the two possible paths for next week, so you're prepared. Scenario A. The geopolitical gap higher. We could wake up tomorrow or Sunday to breaking news out of Venezuela. Silver could open around $75. What should you do? Don't jump in right away. A gap that large in a low volume environment often retraces or consolidates first. Be patient. Let the price stabilize. If you chase the move at 75, you could see silver dip back towards 73 before resuming its climb. The trend may be strong, but your timing still matters. Scenario B. The profit-taking pullback. The market opens and traders unload positions to lock in gains from 2025. Silver slides down towards $68. Here's your action plan. Buy the dip. Keep in mind the roughly $77 value in Shanghai and the negative 7% swap rate. A decline to 68 isn't structurally sustainable. Arbitrage bots will step in to buy. Enter with conviction. You'll effectively be buying $1 worth of metal for 80 cents. We're now at the finish line of 2025. It's been a monumental year. We've witnessed silver breach 30, then 50, and ultimately smash through the prior all-time high at $711. That's a journey you should be proud of. You endured the volatility and held strong when many were urging you to sell. But 2025 was just the opening level. 2026 is the real challenge. In 2026, available inventory will be drawn down even further. The BRICS currency initiative will likely launch, and the Federal Reserve is expected to continue cutting rates, even as inflation persists. Ghost Week is the transitional phase, the calm before the next storm. Next week's volatility may be unnerving. It could be erratic and sharp, but if you keep your leverage low, stay focused on the fundamentals. And remember that over 1.4 million ounces just left the vault, then you don't need to fear. The era of paper silver dominance is fading. What lies ahead is the beginning of the true physical silver age. So enjoy your holidays, watch the evolving news from Venezuela, and get ready for Monday's Open. This is your reminder to take care with your positions. Respect the market's unpredictability and stay vigilant. Merry Christmas and happy trading.